We are now recording. You have the ability to share if needed. It is all yours, and we're here to help, okay? We're here to listen and learn.
All right, thank you guys. And can you see my screen?
Yes, we can. Rob's giving a thumbs up. I'm giving a thumbs up. I think we're good.
All right, starting there. All right, so as Jeremy explained very well, we are in fact Equi, the future of alternative investing. So I'll start a little bit with traditionally what's going on in case people are still keeping count of spending and income and things like that, that I don't think many people are at this point. But as of 2021, taken out of the US Treasury, the US collected roughly 2 trillion in receipts, but has spent roughly 4 trillion. So for those that are interested in seeing where the money is going, income security is now over 50% of receipts. And, you know, all this conversation about the corporate income tax and raising it, it's a fairly negligible amount given everything we're seeing. So I know it's not very in fashion to talk about this anymore, but I still think, you know, for those that still somewhat care. And this is how it looks like when it comes to the federal deficit going forward. So here we are in red, that's 2021, and you can compare it to 2020. In fact, the deficit is significantly greater, and it's accelerating quite a bit compared to prior years. So it seems that all types of, you know, looking at spending and looking at balancing the budget have been totally lost. So the US economy is still standing at about 8 million jobs below the COVID levels. So here is March 2020. The COVID shock and where we are right now, based on the recent jobs data, which, by the way, disappointed quite a bit. And we're seeing some wage inflation. So this is the Goldman Sachs survey. We're definitely seeing the tracker coming up a little bit here. And what's really interesting is that inflation on income is currently hitting the under 60K income the most. So people making greater than 60,000 are seeing some wage inflation, but not much. But at the same time, people making under 60,000 are seeing, I think, one of the greatest increases of wage inflation they've ever seen. And I think it's coming in at about 25%.
Itai, I'd love to ask a question here. Do you think that this is going to be sustained, or is this just temporary because of all the unemployment benefits that are happening?
Yeah, that's a really good question. So historically, when wage inflation do reach a certain threshold, wages tend to be sticky. So once you go over a certain level, it's difficult to claw back on that, and that's potentially hurting small businesses. So even though it's great, people are making more money, but you know, you have to ask yourself how and why that actually happens. So at the same time, small businesses are saying they have never had a more difficult time actually filling in a job, and they're getting desperate to get workers to come back. And you know, this is where you have, in fact, 8 million jobs less than you had pre-COVID. And the bigger reason for that is that government transfer payments as a percentage of income, last time we tracked this, was standing at about 27%, but right now it's 34%. So let that sink in for a second. 34% of people's income today is coming from the federal government or state government.
And I saw something from Druckenmiller presenting to the USC College of Business yesterday, and he was just talking about how insane this is, that the economy is roaring back right now, and yet we still have payments this high that is just discouraging other people from entering the workforce.
It's typically, you know, if you go by the Keynesian economics of things, right? So Keynes basically says that deficit spending needs to fuel the economy back to where it was supposed to be. But even he said that when things are typically good, that's where the government needs to save money and go into surpluses so they can spend during the bad times. But now it's kind of like spend during the good times, spend more during the bad times, keep spending during the good times. So, you know, that's kind of the, and we've talked about it before, is the widespread adaptation of MMT, or modern monetary theory, even though nobody ever voted for doing this by any means, but this is apparently the policy right now. So here you can actually see the total amount of people that are collecting benefits here starting in March, and it's still an astonishing amount of people given the rate of where the economy is sitting right now. So unemployment insurance here, the green line, is by far the greatest amount. So there's still a massive amount of people collecting a good amount of benefits. And what's interesting is this, I think, is one of the better measurements of how open the economy is. And this is the open table seated dinners total aggregate amount compared to previous levels. So here in the dashed line, you can see 2020 versus 2019, and you can see 2020 starts normal. And then this is COVID, and it goes to minus 100% for a couple of months, which is pretty incredible. And then it reopens. And here we are in 2021 in May, and we are just 10% below 2019 levels. So again, if we're 10% below 2019 levels, and this is a very good indication of how the economy is opening up, why do you have that many people still collecting benefits? Unless the government is just willing to extend it beyond where they probably should. So can the government keep doing this for a long period of time? Now we're having some issues, right? We're having major inflation risk. We've seen the price of lumber going up. We've seen the price of copper going up. New home builds are going through the roof. We're having a lot of supply side issues, and there's extended inflation everywhere. Now we're seeing wage inflation too. And a part of the reason you're seeing the sub 60K wage pressure going up that much is because you need to pay people a lot more than $15 an hour for them to even show up and do the work, right? I can actually tell you, I have a small home renovation project I'm trying to do, and I've had so far 4 contractors just bail out and not show up every time, no matter how much money I tell them I'm going to pay them.
Maybe Itai, what you can do for the next call is take a picture of this giant hole that's sitting in your backyard, which has been there for no joke 2 months. It literally, if I was Itai's neighbor, I would think that he's actually burying dead bodies, but nothing has happened, and his whole backyard is completely toast. Like none of that grass will regrow because it's just sitting there.
Yeah, well, thankfully I understand the macroeconomic factors contributing to that micro economic factor, right? So one of the issues is that this is actually hurting small businesses that, you know, are pretty much the spine of the American economy, or has been. And it's moving a lot of market share to very large cap companies that already control a very large segment of the economy, because they can afford to pay those higher wages where small businesses don't necessarily have the ability to do that. It also increases the risk to the dollar as a global reserve currency, because if you're China sitting there and saying, I'm tired of getting paid back in devalued dollars, which they already had before with the Belt and Road Initiative, and if you're interested in that, please listen to our 3-part call about the petrodollar system. I think it's really fascinating. And also it creates a lot of market dependency on government actions, right? The markets are addicted to stimulus at this point. And even a couple of weeks ago, Yellen said, well, maybe we need to raise interest rate. The market went down 2% instantly until she walked it back right away. So I think that's not very healthy. And of course, interest rates are heavily suppressed. If you want to get some yield in a bank account, it's effectively zero. Borrowing is very easy if you're wealthy, not so easy if you're a small business. And that's an issue on its own.
Got it. Itai, do you want to quickly pause? I know you went through a lot of stuff really quick. Do you want to see if there's any questions?
Yeah.
Who's feeling like asking question number 1?
So I mean, I know just all the comedian weed guys that I know, and they ain't going back to work. They're making more money, making $600 a week and selling, and they can spend all day selling weed and supplementing their income. They're making like $40,000-$50,000 with the way things are there, and they're not planning on going back till they cut off the checks. So is there any talk of anybody in government with power that's even thinking about cutting off the checks? I know some states, wasn't it like North or South Carolina said, that's it, we need people back employed?
I think federally, it's not going to be until July when you're going to see things slow down a little bit.
Cool. Awesome. Continue it on.
All righty. So basically what this is doing is, you know, it's helping very large cap companies, right? Because at the end of the day, they're the biggest beneficiaries from that. And today the S&P 500's concentration is quite high. So it actually went down from 25 to 21. I think it's a little bit higher right now. 21 to 25% of the entire stock market is just 5 companies. And 16% of all earnings are essentially those 5 companies. So the concentration risk in the stock market has actually never been higher. It's actually higher than what it was during the tech bubble. So if you're really thinking about one of those companies that is the larger one, right? Apple, $23 billion of revenue comes solely from AirPods. So the reason I bring this up is that try to think for a second how much of the US stock market today is AirPods. Kind of wild.
How much of what?
Of the entire US stock market depends on the revenue coming out of AirPods, given the size of
a quarter of a point.
I think it's closer to a point.
So basically, if you didn't lose AirPods, if people didn't lose AirPods and didn't have to buy 4 different pairs, it would actually be a quarter of a point. But because we all lose them and have to buy 4, that's what makes it at a full point.
I know, but like AirPods literally have double the revenue of Uber. All right, I'll leave that.
That's crazy. Itai, we have a question in the chat.
Okay.
How real is the fear that wage inflation will result in consumer price inflation?
Yeah, that's a real fear because up until now, we actually haven't seen wage inflation hitting the lower income tiers. And we've covered in prior calls. And, you know, the QE policies basically benefited the rich and the asset owners more than anybody else. And they tend to spend about 47 cents of every dollar earned, where lower tier income classes tend to spend about 97 cents per dollar earned. So that just translates into more, potentially more inflation concerns.
But aren't they spending that to like just retire their debts or buy assets like crypto or stonks? That was the other part of my question. So
the top 20%, so there's actually a lot of research on it. The top 20%, or really the top 10%, are the ones that typically buy assets because they have the disposable income. But people that make lower amounts of money, they're typically more in survival mode and they need to either pay debts, credit card debts that they do, that's deflationary. But other than that, they buy more stuff and they do increase their consumption. So, you know, depending on what income tier gets the extra money, that creates a very different outcome. And the reason you didn't see a lot of inflation 2009 through 2020 in the real world is because most of the money came in QE that benefited the top 10%. And as a result, you know, that ended up funneling into asset prices. And we talked about it in prior calls as well. You can check some of the recordings. We share some good charts showing that.
Itai, stop pitching all of our calls, okay? We know that this is your whole goal for this whole presentation.
Well, it's kind of nice that these things have already been laid out in a good chart format. So I'll continue onward. So, you know, in the past, this was a good proxy for policy in the Fed. You can actually look at small business surveys of how hard it is to fill a job as an indication of how hot the economy is and as a proxy where interest rates should be. Because it makes sense, right? If small businesses are having a hard time filling a job, that means the economy is hot, demand for money is really hot, so interest rates should rise. But the Fed is significantly behind the curve right now because small businesses have never had a harder time filling jobs. And we're sitting at zero bound and probably going to stay at the zero bound until at least the end of 2022. And even if we raise interest rates, probably going to be not a very significant amount. And this has been correlated fairly well in history, but even in this last round. And now the post-COVID rebound has been very fast and furious. And, you know, this is definitely some concern of inflation.
Got it. So if we have concern of inflation, are you going to tell us at some point what we can do about that?
Yeah, we're going to talk about how the renegade market is creating a solution right now. So the Fed's balance sheet expanded in between 2019 and currently from just shy of $4 trillion to $8 trillion here, only on the total security side. So, almost doubling the amount of money held on the Fed balance sheet. So that's quite a bit of money printing that has taken place in the last year. And I think a lot of people don't realize this. And I think this is a really interesting point. So think of it this way. The Fed is a hedge fund. It's in fact the world's most profitable hedge fund. I'll talk about that in a second. And the US government is the LP in this hedge fund. So when the Treasury creates the debt instruments, the Fed actually buys it. So the Fed creates money out of thin air and then uses it to buy those treasuries. The US government pays interest against those treasury securities, right? Even if it's 1%, because it's a very low interest rate. But this interest is essentially profits. And if you're sitting on $8 trillion, even 1% is a good amount of profits. And those profits actually end up back in the government's pockets because the Fed pays most of it back to the government besides what the Fed needs to run its operation. But what's really, really interesting is that these profits that are generated by the Federal Reserve balance sheet are actually considered corporate profits. So the ratios of corporate profits that you see are not inclusive of the real profits are actually lower than what they would be, which would make the market appear less expensive than it really is. So just a little bit heads up there. Stock buybacks are back to record highs because low interest rates and a lot of money printing. So what else do you do if not buy back your own company? And the most profitable company on planet Earth is, it's not Apple, it's the Federal Reserve.
Wow. That's unbelievable. So we should just make this a publicly traded entity. Its market cap would be insane.
I mean, look, when you can create your own currency, I guess in the crypto space, people do that too. They create their own currency, but you create your own currency in which the entire world has to trade on and all the commodity deals have to happen on, and it's backed by taxpayer dollars, right? So you can create your own currency as much as you want. You expand the balance sheet and then you buy bonds and then you make the interest on $8 trillion. It's going to be a very profitable company.
Makes sense.
The revolution is underway. The free market is getting annoyed with what we're seeing. And I think there's a potential creative solution coming up to a lot of these issues. And I'm going to let Udav talk about it. Are you ready, Udav?
Real quick, before you do that, can I just intro Udav real quick?
Please do.
Okay, you guys are all really lucky. Udav is a very, very talented individual. He's currently a trader for BP, but he's very deep in the DeFi space. He's the type of person that likes to build things that everybody can use. So he likes to say that DeFi found him, and if his grandma can buy the type of assets that are being created in DeFi, that's something he wants to work on. So he is very in on it. You'll want to ask him a ton of questions. We have some other crypto studs in this audience. So please, without further ado, I'd love to pass it over to Udav.
Hey, thanks, Jeremy. Can everyone hear me pretty clearly?
Yes, I can hear you.
Awesome.
Go for it.
Cool. Well, nice to meet all you guys. This is one of my first couple calls with the Equi folks, and it's very exciting, the stuff that they're bringing to market. And I'm sure there's some new offerings coming that are even more exciting. I'm here today just to talk about how I've seen DeFi grow in the last kind of 3.5, 4 years, given how young it is, what its applications can be, starting with the technology, which is where I first got involved in the smart contract side. What does decentralization mean? How can DeFi create applications and opportunities for people? And then how do you generate P&L through this? So let's get started. Can everyone see the screen?
Yep.
Yep, cool.
Sure can.
So high level overview, I'm sure I'm speaking to an audience of people with all sorts of experience in this space, but just to get everyone on a level playing field, what is a blockchain at its core? It's a globally shared, decentralized, traditional transactional database. So when you hear about a database, normally you probably hear about a centralized server maintained by AWS or Google or different companies that are maintaining a centralized set of data in a set of maybe different locations, but all that data is holding transactional or account information. The difference and the novelty that comes with a blockchain is it essentially takes an approach to connect a series of blocks. Blocks are a stack of transactions. So when you buy or sell in an account, or you use a contract call, which can be a smart contract or a programmatic application that is set to follow a certain amount of rules to achieve the final end state. So the novelty that Ethereum protocol and the Ethereum blockchain has added on to the blockchain concept is now the idea of a distributed state machine, which is in which the state is a large set of data structures, which keeps track of an account, both of its balance in and out, as well as the contracts that are getting run through and through the
So
blockchain.
what used to take place in a bank's ledger is now just happening in disparate systems all over the place.
Yeah, and in a decentralized way in theory, and we can talk a little bit about what the difference between theory and practice means in decentralization. But just to level some framework here again, I think an important transition that we've seen happen twice, at least in my life, was from Web 1.0, where you can load a heavily pixelated image onto your computer and participate in the internet economy only through just reading, through visualizing things. Then Web 2.0 came around. We could start to interact more with the databases. We could start to interact as users with websites. But at this entire time, these websites and their owners have entire control over the privacy of our information, and it's at their sole mercy with that information, what can be done with it. And we're missing this fundamental transactional layer. So what the transactional layer provides relies on the decentralized architecture that's built on the Ethereum blockchain today, which constitutes most of DeFi and has roughly $80 billion of total value locked. And it essentially focuses on three things. First, making economic value the native feature of the internet. Second, creating decentralized applications where users can participate in this new internet. And then third, giving everyone control of their digital assets, whether it's their identity or their data. So at a high level, what does this stuff mean and how does it translate to you? So on a state layer, I've mentioned there's two blockchains that many people have probably heard of, but on top of that state layer is built a computation layer, which allows humans like you and I to interact with the native blockchains through the form of, in Ethereum, what's known as the Ethereum virtual machine, which is at its core an execution environment for Ethereum smart contracts that are built in languages like Solidity and Vesper. And this allows the transactions that we're talking about to take place and accounts to be created and state to be maintained.
So for in human speak, if Jeremy wants to interact with Ethereum, why do I need this EVM and how do I use it?
Yeah, so when Jeremy wants to interact with Ethereum, it's more than likely through participation in the native currency, which can only exist because of the existence of the computation layer. So the EVM is what validates transactions in between nodes in the Ethereum blockchain. And it's also what allows people to create new items and create new applications on top of that blockchain.
Got it.
And some of the more exciting features that are getting built out on component levels and protocol levels is functionality to trade on a various set of products, to lend and borrow, to create derivatives, and then take that into a very user-friendly approach, which is what DeFi has really been working on since the end of 2020. So high-level summary, at its core, all we're talking about DeFi is it's a technology stack. On a blockchain, the first layer is always consensus. How can a blockchain identify consensus to validate the legitimacy of its transactions? On top of that is the computational layer I mentioned. And then the key layer that a lot of people interact with comes through the presence of smart contracts, which allow us to algorithmically design programs to have guarantees for certain executions. For example, to make this a lot more appreciable, let's say you ran a vending machine and your vending machine consistently has to give out one candy bar for the input of $1 if the right cell is clicked. The logic of the Ethereum virtual machine combined with smart contracts can essentially encode that in about 15 lines. And now you can have your entire vending machine network all over the world running on the EVM, which can make decisions purely based on state of an account, which we've spoken to a little bit earlier. So like all early computers, blockchains have had some strengths and weaknesses. So we saw with earlier PCs, they can be sometimes slow and they can have a poor experience to use. With smartphones, they became very pricey to start off with, and they had a lot of various inputs that weren't friendly to the initial user. And the same thing we've seen with early blockchains in 2015 through 2017. People understood there were trust guarantees, but the user experience and the ability for the marginal user to interact was pretty sad and pretty challenging. So what have we done in the last 3 years? We've essentially built a framework of front-end based applications that people can interact with in a friendly version. So now framing the problem, why is decentralization picked up, and what is the stuff that Itai said so far about the Fed's balance sheet and general ideas of monetary policy, and what does it mean for the DeFi ecosystem? I want to start off talking about what the big problem is in terms of people who are underbanked. The largest resource that most people don't have access to these days after the internet and kind of core commodities ends up being a bank account. So the access to participate in the money system, whether it's transfers or financial services, and keeping their personal data in that entire process and participating in different economies. So for example, how can my grandmother in India have access to purchasing a synthetic version of an equity on a US exchange? These are problems that it's looking to tackle, and they've actually built out a pretty good ecosystem for in the last couple of years. So similar institutions like central banks, commercial investment banks, exchanges, brokerages, DeFi has essentially created an on-chain version of many of these applications and given us the opportunity to create a portfolio of assets within them and also to build on top of these things. So to build out a insurance-based program on the Ethereum blockchain, we have a couple examples here to build out a non-custodial wallet, which is one of the coolest features of DeFi, I think, and similar asset management things to what Itai and Jeremy mentioned.
I just want to pause here for a second because I think this is important. I just want to make sure I'm conceptually understanding it. There's a whole world of people in the world that are underbanked, don't have access, resources, whatever. Once they start getting their hands on some of these crypto type of assets, now they've entered this whole world of potentially DeFi, where all these tools that already exist for us that have the bank accounts and have familiarity with the system, they can now access it, but they're just doing it through DeFi protocols. So they get access to the same stuff as us, just in this whole crypto environment.
Yeah, and it's finding ways for the ensured reliability of these things. Particularly, like, what does it mean to be decentralized, like we were talking about earlier? How can my grandma continuously have access to this, even if she's not a very common user of the internet? And we're still in very early stages. I mean, we've seen the development of these applications that are completely not user-friendly, specifically focused for developers to build within. So very young in the life cycle of this stuff. So yeah, I wanted to do a side-by-side of custodianship and some of the bigger benefits that are easier to see in DeFi. I think the first big one is having complete access to your money through a hardware wallet or a non-self-custodial wallet. I prefer a self-custodial wallet. This simple piece of technology supports an entire system of monetary policy, right? I can participate in holding my entire asset base onto this hardware wallet rather than in the traditional finance ecosystem being held by companies, which can have settlement issues like we've seen with a bunch of stocks because of T+2. So many solutions that this problem is trying to tackle, and very interesting to see how it's growing. A big one is transactions. Transactions can happen very fast, as maybe users of different DeFi protocols have seen. The pseudonymity, which is another big feature to help keep things out of line with KYC and financial identities. And then the biggest one, interoperability and openness. Anyone who has access to the internet can participate in these financial services on DeFi.
Do you want to pause there real quick and maybe take some questions?
Yeah, I saw a couple of good ones in the chat. Someone was asking about the biggest decentralized exchanges. So I think the exchanges like Uniswap, which is the largest decentralized exchange by volume right now on the Ethereum blockchain, that's doing around, I think, 30 to 40 billion a month in volume. These exchanges have tried to do something that no one has approached before in terms of how they build an order book. They rethink the concept of a continuous limit order book by building an automated market maker. Essentially what that means is now everyone who's participating on the exchange can provide liquidity to the products that are traded on the exchange in return for collection of a set of fees. So Uniswap may have a 0.3% fee, SushiSwap may have a 0.25% fee, and these can be collected in the native token of the protocol, such as Uniswap or SushiSwap. And the way that the native tokens are distributed is through a governance mechanism that's initially established when the protocol is made and potentially iterated through consensus voting on the governance holders of the people holders of the governance token, let's say.
Got it.
Valuing them is tough, definitely very tough, because many of them are targeting different set of users. Many of them are targeting different speeds. So it really is, it goes on a case by case basis. Happy to touch on any of the specific ones later.
But I think the broad idea is mainly that you're basically taking the idea of an exchange. So instead of being dependent on the NYSE or the NASDAQ or the London Stock Exchange, in order to make a transaction, you're literally allowing anybody and everybody to become a market maker and to say, if I have, USDC and I have Bitcoin and I have Ethereum and I'm willing to provide pools for that liquidity, I become a market maker. I get compensated for taking that risk. I get money for doing that. But in a way, there's millions of mini exchanges everywhere out there. And then you have less risk of a one centralized exchange having issues, like a flash crash on the NYSE or something like that actually reduces some of that financial risk, right?
Yeah, and you're in self-custodianship, meaning you choose which exchange you participate on. So just because your stock is only listed on the NYSE doesn't mean you shouldn't be able to trade it from the TSX in Canada. So decentralized exchanges also make that interoperability a lot more accessible to you and
And
I.
I see on the chat people are talking about BlockFi. So let's make things a little bit clearer. So there's a decentralized exchange where everybody's a market maker and everybody and risk goes around. And there's things like BlockFi or Nexo literally go and they take your money in stable coins and they lend it out to people that want to buy Bitcoin or things like that, and they make the spread. So they are actually a centralized exchange, and there's counterparty risk. So your risk here is, BlockFi goes under, even though they have 25 billion in deposits right now and they're heavily seeded or whatever, but they could in theory go under, and you have counterparty risk. In a decentralized exchange, you do not have the counterparty risk.
Good question. Where does the IRS stand on all this type of stuff, guys?
That's a great question.
Nobody knows.
Tori, take a shot.
Actually, actually on the lending front, it's actually better defined. It's like, this is actually just, they're treating it as dividend income. And so if you make deposits and then you earn interest on those deposits, like they expect you to pay interest as you would on dividends. So actually BlockFi and Celsius, which are two of the largest centralized lenders in this space, they now issue automated tax statements that you can file with the IRS. So I've been using those services since, they were 6 months old, and I've filed taxes and had no problem sort of dealing with that up to this point. Where it starts to get more complicated is with the decentralized lending protocols. The thing that's technically a bit harder to determine and why you need a lot of software is because right now assets like Bitcoin, if there's both a change in value and this is different than like just earning interest on a US dollar deposit. Every time you're trading in and out of an asset, you should be, marking to market on both sides of the transaction, and then technically paying cap gains, because Bitcoin is treated more like property versus the dollars you're earning interest. That's much simpler. But like Bitcoin is treated like, you're either experiencing short or long-term cap gains. In this instance, obviously it'd be short-term cap gains, but you'd be ideally, keeping track of every single entry and exit price if you're in one of these market-making liquidity pools and somehow paying interest on it. Or the way it works now is you make a deposit and you receive an LP token, and then you're earning interest out of that. So then you don't mark to market on anything. You just kind of pay, you should be paying taxes on the dividends you're earning on your LP token. That's probably the best. But the IRS doesn't understand this stuff yet. So you kind of just show good intention.
Cool.
Is the LP token like a Bitcoin or Ethereum or just another cryptocurrency?
Kind of. Different protocols handle it differently, but actually LP tokens tend to be NFTs, which people have, there's a lot of ballyhooed, around NFTs and like art and collectibles, but actually you can think about an LP token as like a deposit slip for what you've put into the protocol. And it's basically a non-fungible token that says, I've deposited X amount into this liquidity pool, and therefore I'm entitled to Y, dividends out of the pool. And then when you come back with that, there's no other token like it, right? That's the whole idea. It's a non-fungible token. You then return that token in exchange for the liquidity that you deposited.
The only issue is you can't lose your wallet or figure out how to get into it, because that would be a big issue. So
actually, and I don't know, are you going to touch on this, Udav, but do you talk about impermanent loss at all?
There's a section on it. I took it out of the deck
Okay.
because it's very detailed form of it, but I'm happy to talk about it because that's what I spend a lot of time
I
modeling.
think that's
We should mention that because that is a risk to anyone. If you go and do this for yourself, you need to understand at least the concept of impermanent loss.
it's very similar to, if you know a little bit of options, it's the equivalent of shorting a straddle.
Yeah, but more protection on the upside.
Yes.
Yeah.
I'll let you continue.
Yeah.
We'll get there.
Please continue, because we could go down this for quite a while. We want everybody to get the benefit of this.
Yeah, these questions are great, and please keep them coming. I mean, I'm trying to talk about this from a technology and framework perspective, and we're about to jump into the applications to answer a lot of the questions that folks have brought up already. But just for a framework, I think when everyone sees new DeFi projects jumping out there, there's a core set of questions that I always ask, and there's more quantitative ways to measure. But the really 5 categories are: figure out how permissionless this thing is. Can anyone participate with just a connection? How trustless is it? Does it require you to have complete faith in a central identity or central entity to make sure your transactions are valid? How transparent is it? If I wanted to right now, for all the protocols that I participate on, I can go and find their GitHub repos and look into see how those smart contracts were built and who audited them. And then how efficient is it, which is a very personal thing at the end of the day, because some people look for capital efficiency where they may be providing liquidity, but then they can't take it out for 21 days. So different criteria for different protocols. Cool. So I'm just going to jump into the applications because there's a lot of interest here, and we can really get into the whole world of DeFi by understanding how users can interact with these apps. So the first one we mentioned, I've talked about a lot, these self-custody wallets. Essentially, it's a bank that you have entire control over at any time, anywhere. This is a novel product in and of itself because this is what allows people, once they on-ramp out of fiat and into crypto, they can participate in the entire ecosystem as long as they're in control of their wallet. So many people have probably heard that you make a Coinbase account, Coinbase has your private key, which is what uniquely bonds you to your money or your assets. But when you build let's say a hardware wallet or a wallet in which you're a self-custodian owner, you now have ownership of that private key as well as the public key you can use to transact. Stable coins, this is a field in which Tori is super experienced in. They're essentially systematically pegged to the world's largest fiat currencies. There's different types of stable coins. You have fiat collateralized, which are one-to-one to the dollar. You have crypto collateralized, which are collateralized to different cryptocurrency assets. And then you have algorithmic stable coins, which can utilize various forms of internal monetary policy, which the protocol is trying to create itself, or something as simple as seigniorage, which many people may be familiar in the traditional finance ecosystem. Next big one we've mentioned is lending and borrowing. We're going to jump into a quick example here in a second. Essentially, this is already in play. There's, I think, roughly 30 to 40 billion of value locked within these lending and borrowing protocols these days. Essentially, lenders send their money to a smart contract designed specifically to follow a set bonding curve or a credit utilization curve. And that holds the borrowers accountable to their word programmatically for liquidations to take place if the borrower suddenly falls below or beyond a certain threshold. And then there's derivatives, so creating ETF-like exposure through swaps, futures, and options markets, which are going in massive liquidity here in the last couple of months. There's decentralized exchanges, which we've talked a little about before, and the idea of an automated market maker, which is also subject to impermanent loss, like Tori mentioned. There's oracles and prediction markets. So oracles are the mechanism which connect on-chain transactions to off-chain data sets. So for example, if there's a synthetic version of your favorite public equity, it still needs a reliable price feed that will probably not be on-chain for the near future to communicate with. So oracles can create some pretty exciting ways to try and bring some of those external data sets on-chain, or at least on a side chain or a layer 2's chain that we can talk about in a different level. And then finally, the one that excites me really the most are decentralized autonomous organizations, or DAOs. To me, the DAO sits in between an idea and an IPO. I've seen this thrown around a lot, and it's quite exciting because now it allows organizations to incorporate entirely on chain using smart contracts and using a system that relies on people participating through governance. So anyone who becomes a member of the DAO can get assigned a certain amount of governance tokens to entitle them through voting rights into that organization. And now you've created an entire group on chain, democratically decision made, where people participate in creating the rules, creating the ownership, and then distributing it to others for performance.
So what you're doing in the traditional finance world can basically all be done on chain.
I think we're getting there. I don't want to say it can all be done yet because we're still so young in this. We might see a couple of things change in the next few years, which might send this on an even more exponential trajectory. You might see mass adoption of different digital currencies that can also put DeFi in a place that it's not in today. So, for example, if there's a fork in the Ethereum protocol, like the London hard fork is happening in a couple of months, hopefully, and before the end of 2021. That's going to change the way the contracts are enforced. That's going to change the way transactions are done, the liquidity is done, things like that. But I think we're on our way. We're definitely on our way to seeing DeFi cannibalize a lot of traditional finance.
It's not even finance. I mean, in this case, it's an LLC protocol, right? So you can literally say, this is our company, this is the LLC, and here's the smart contract that's going to say this, this, and this. And if we agree on one thing, and then it just follows it. It follows the protocol that it decided to do.
There's a really good question in the chat, some examples of DAOs you can participate in. So 2 weeks ago, or about 2 weeks ago, there's a DAO on an organization called Rari Capital. And this is the DAO that they use to make decisions as to whether or not they hire new people. So anyone who owns tokens, RGT tokens, which is their native token, can participate in the hiring of a new developer, a smart contract developer, a front-end engineer, a product manager, through voting, using their tokens to vote in the DAO. So that's one that I just participated in myself 2 weeks ago. And anyone can participate as long as they own the native token. So now onto market sizing. This is funny because I took the screenshot on the bottom right less than a month ago, I think. And since then, total value locked in DeFi is about 85 billion. So it's increased by about 10 billion there. And a lot of this is happening starting with the protocols we talked about earlier for lending and borrowing, such as Aave and Compound, and MakerDAO, which is one of the largest, if not the largest right now in the space. And they have about this number of 9.4 billion is roughly 12 now. So growing very quickly. Stable coins, the kind of the pinnacle of the DeFi infrastructure. We mentioned before, it's how you get access to participating in a lot of these decentralized exchanges once you've on-ramped from your fiat into your crypto world. So again, there's 3 types here, and they have a ton of liquidity. I mean, we can see on the top right, we have about 75 billion of transactional volume happening on these stable coins each day, and different ways to get them all. I think Tori has some representation here too. So TUSD, one of the OGs, is a very interesting stable coin. One of the categories we've talked about, it falls into different types of collateralization. And that's why you've heard of USDC or USDT, different ways to create the stable coin, but all it needs to do is functionally enable a guarantee to get $1 out on the other end if you need to, and also enable you to participate in these ecosystems.
Isn't USDT a credit hedge fund?
By the way, that's what's funny is people think that it's Elon that's shaking the crypto market. It's not Elon. It's the fact that Tether revealed that they're essentially taking on massive credit risk and investing in short and long-term credit, which is ridiculous, like a mixture of corporate debt and all this random shit.
With the stable coins, they're supposed to be holding against the assets.
The dialogue on Twitter is like that Elon is causing the like tumbling of the markets. It's not at all that. It's that Tether basically revealed that there's a massive credit risk that underlies like a huge portion of crypto right now, and people are freaking out and moving. Like any risk manager worth their salt is moving away from Tether right now or attempting to hedge.
Sorry, didn't Tether have a pretty problematic history even before this?
Hugely problematic, which we can't get into in this call. But I've never held a Tether, nor would I ever, which is why we created TrueUSD.
Let's back up for a second. So people who own Tether stablecoins are trying to get out of Tether. Is that basically it? So because they're calling their capital back, is it forcing liquidations, or like what's causing?
I think a lot of it is because there's a lot of Tether that's involved in the market making pools against other crypto assets, and then when they take that out, like they take back their deposit slips, then it's taking liquidity out of the system. It's more about all the stuff in the lending and borrowing system than the just flat out Tether.
Yeah, I would say hypothetically, we should see a big transfer of value from Tether to other stablecoins if people know what they're doing. But the problem is there's a lot of people who don't know any better and they just think Tether represents a dollar, but it doesn't. It's basically like it's as bad as the US dollar.
Also keep in mind that
Low
the crypto don't go that low, but keep in mind that the crypto space is very much driven by the short-term debt cycle. So if you're actually following like the borrower rates and things like that, so the way it works is the reason you can lend your money and get 12 to 15% return is because this market is super speculative. People think Bitcoin's going to go to 100,000 next month all the time. So they're always willing to borrow to buy more Bitcoins and things like that. So it's very easy for Bitcoin and to drop 30% like it's nothing because so much of it is bought on leverage literally all the time.
And you can literally get 100 to 1 leverage on some of these exchanges. So you can buy Bitcoin exposure with what, $500?
Yeah. I think like even FTX gives you like 101x leverage if you wanted to.
Yeah, the concept of like liquidation cascades in DeFi has been pretty challenging. I mean, the industry has to go through it and it has to find the stable coin that people prefer. Things can get out of peg, and if they're not built in the first place to hold that peg through some sort of non-manipulative way, then we can't expect a lot of these crypto stable coins to hold value. And this is going to be an exciting shakeout over the next year. Which one truly has market dominance and how does it change? So just for some context on the actual algorithms and the applications that people may interact with on a day-to-day for this communication, Uniswap is a decentralized marketplace, so peer-to-peer network. Aave is a decentralized borrowing and lending marketplace where you can do some of the things that Tori and Itai have mentioned. Yearn is a yield aggregator, a yield generation method, and you can also beginning an insurance protocol to use your Ethereum assets as collateral for some of insurance programs that you may take out. So yeah, lending and borrowing. This is an exciting part to participate in because of the relatively high yields a lot of people have seen. I wanted to just simplify it down to the concept of at the heart of every lending pool, which is a reserve. So a lending pool has reserves of various denominated assets. Users can borrow these funds, granted they lock up a greater value as collateral, which backs the borrow position. And then specific currencies can be pooled to use as this collateral. And then they can find a set of borrowers to, for example, in this case, someone is borrowing DAI, which is also a stable coin. And in return, they're going to be trying to buy Ethereum with that. So inherently, the lender, the depositor has to provide that amount of DAI, and that loan has to have a specific loan to value ratio that's always maintained. And if it's broken or under collateralized, then that loan, that liquidation immediately gets paid. And again, there's a lot of people who are providing liquidity on both ends. So that's why we see if suddenly a ton of liquidity gets pulled out, the entire pool may need to rebalance depending on how it's initially structured.
And Udav, how might this lending be different from staking?
Yeah, so lending is different because you're taking out, you're trying to take a loan out at the other end, right? And in staking, your functional role is to be a liquidity provider in an automated market maker. So all that means when you're staking, you have two assets. You have a stable asset, let's say, like DAI, and you have a volatile asset like ETH. So you pair these together on a ratio of 50-50. Let's say you put $50 of ETH and $50 of DAI together. And now anyone in the pool who wants to buy or sell DAI, let's say Jeremy wants to buy one DAI, or Jeremy wants to buy $1 worth of ETH from me. He can come into this pool, offer to sell his DAI, and show an offer to buy an ETH, right? In a continuous limit order book, you'd have to go in, you'd have to transact at each one of these layers, and you have to put in a price. With an automated market maker, you're guaranteed execution of a price at that time. So now Jeremy's 50 DAI and $50 worth of ETH have now gone to someone who's looking to buy that marginal DAI. That makes sense.
You are in fact the exchange.
Yeah, you are a market maker, and you are participating just as much as a traditional market maker would in a lob. So, and yes, it is the mechanism for validation as broader is a mechanism for proof of stake, which is a very exciting consensus mechanism. We could do an entire presentation on. That's, I think, the future of a lot of these young blockchains that are energy intensive. But
And I
So, yeah.
think one of the things that's the most exciting here is that we haven't talked about is, in fact, you are the bank. By lending money, you're taking all the profits the bank normally would because it's decentralized. And then the second thing that's even more exciting is that the borrow rate is simply controlled by the market supply and demand and not some kind of central entity that's going to come in and say the fund rate is at 0 or 0.25 or at 1%. This is literally a factor of the market. People want to borrow, you want to lend, here's what the price that you agree on. That's as simple as that.
Yep. So this is another more in-depth lending example of the types of instruments that people can have access to. So there's stable rate, variable rate loans that you can get in denomination of Aave, which is the native token to this protocol, and also in denomination of a stable coin. And anyone can participate. Again, free system, very democratic in its sense. As long as you have a wallet and are connected to the internet, you can, again, access Aave and participate. Some context on market size. Roughly the top 3 protocols, Aave, Compound, and Maker, are lending about 25 billion as of last month. So this thing has been growing almost 3x since the beginning of this year. And we're starting to see now people find pretty interesting ways of using this to buy houses. So I think here pretty soon we're going to see people using this to buy different tangible instruments in the real world because they've found someone on the other end to give them that loan that they need to buy it.
You should note that things like Venmo, right, are now accepting USDC, right? You can literally you can do all this stuff, make this money in crypto, then spend it in the real world via Venmo, which is something that we all use pretty ubiquitously.
Yeah, and Visa too is moving pretty quickly on the adoption of USDC and using dollar settlements in USDC, which it's great to see traditional finance embrace that. And now once it meets the challenges of scalability and transaction speeds, I don't think it'll be too long before we're there.
So I'm almost thinking it is like, hey, all these people are sitting on mounds of money in the crypto space. They don't want to take liquidity right now because they don't want to get a taxable event.
They borrow
in the system. They borrow, they spend in it. It's now allowing the spend to start happening in the real world. This could kind of lead to a lot of the things that move money out of the fiat system and truly into this new decentralized world.
Yeah. And people are going to start at it very slowly. I mean, countries are going to start experimenting for just a certain sector of their economy and see how that responds, see if they can initially do a core adoption of a certain blockchain in a certain region, and then build applications specifically for them. Again, there's the big distinction between a public and a private blockchain that we haven't talked too much yet about, but many ways for individuals and countries to scale these on pretty exciting levels.
Yeah, and let me I see some people are saying it's very risky and things like that. I'll just comment to that a little bit. So I think that with some of these lenders, the risk is actually, it seems high just hearing about it, but I've done extensive research into it, and it's actually not as high as some people think, because a lot of these loans that are given are extremely over collateralized. So let's look at BlockFi as an example. They wouldn't give more than a 50% LTV. So imagine you have $1 million worth of Bitcoin. They will only lend $500,000 against that. So essentially you're making your 8.6% against that loan. And then if, let's say, the value of Bitcoin drops by a certain amount, whoever had that loan has to post more collateral, is going to get an algorithmic margin call. So your loan is not exposed to the volatility of the crypto assets. But if there's not enough demand to borrow, then maybe your yield is not going to be as high, and that's going to change in the future. Decentralized protocols have different risks because literally they could be like, the smart contract could have a bug in it. And as a result of that, your money could simply disappear just because someone didn't program the contract correctly. So those are very, very different risks. And that's actually not a price risk. It's a technology risk.
Yeah, and someone made a good point about comparing that to counterparty risk. And that's something we saw in the 2017 ICO boom. It's protocols are created with no functionality, purely for people monetizing the native token through rewards and then just dumping it later. So this is why the ecosystem has started to adopt, and already adopted quite well, the idea of having audits from multiple sources and multiple, there are very reputable organizations out there that are doing audits for these smart contracts. And even after that, there's still been bugs that have been found and exploited by hackers. And a lot of the way the open source ecosystem works is if you do find a bug, there is a bounty to be received from the reserve of the protocol itself for identifying and helping them squash that bug. So it's another mechanism that they're using to iterate on better policy and better protocol design. So on DEXs, briefly covering, we talked about Uniswap earlier. So as a broader DEX ecosystem, there's really 5 or 6 that are dominating volume, which is at roughly around 80 to 85 billion these days. And it's growing very quickly as more people adopt the on-ramp and start to move into crypto as kind of their digital native transaction currency. Just some more on DEXs. And then a bit of a taste of timeline. So it's about 31 years for the SIBO to list and have a lot of liquidity and participation on volatility options and futures. And I'm sure some people in here have had experience throughout this entire time. One of the novel things that I think really allows DeFi to emerge with the idea of money Legos is that people can now take these established concepts that are already well written and well documented in code, such as the VIX formula, whether it changes or not in another 5 years, different question, and encode that on chain so that now you can use derivative products to trade volatility indices on chain. You can trade synthetic assets, so your favorite stock that I was talking about earlier. You can create future smart contracts, essentially find ways in which you can now make a bet on a prediction market in 2 years. So for example, on the top right is UMA. UMA is a protocol that's essentially built for people to do exactly this. Mark Cuban tweeted the other day, he wanted to make a bet with someone that his basket of crypto assets would outperform someone else's basket of S&P assets. Within 3 hours, UMA protocol had built the smart contract, sent it for audit, and reached out to Mark Cuban to say, we'll settle this for you on chain, come back in 10 years, and the $1 million can go to whoever wins. And this is all done through UMA. So just another exciting application of how these things can get rolled out very quickly and how money Legos will play into our day-to-day. And then the big question, right? How do you build a portfolio of these assets? How do you understand the smart contract risk? How do you de-risk these protocols by working with developers? A couple of the big strategies we've talked about so far, liquidity providing into individual pools or into yield aggregators that combine multiple assets together to try to change the way your impermanent loss or unrealized mark-to-market P&L curves look. Market making bots, which a lot of the large research firms and institutional firms are now getting into. Fixed yield products, which can be kind of a trivial thing, just sounding like fixed yield is not possible in crypto, but many interesting ways to splice together the idea of a deleverage protocol, a protocol that doesn't encourage a lot of leverage being taken, and products that can give people back yield for participating in that kind of transactional system, lending and borrowing we talked about. And then one really exciting one that has gotten a lot of attention this year or in DeFi summer starting last year is venture capital pre-sale investments into protocols that are very young, may not be actually running in a mainnet, which is a communication platform everyone can participate in. And then a lot of arbitrage opportunities that are popping up between these exchanges through smart routing and order flow measuring, things like that. That's a pretty cool frontier that's happening in DeFi right now.
And we're in Equi, we're actually looking into launching a potential DeFi arbitrage fund, which we can tell you about more later. But there's too many opportunities that we want to take advantage of some. And right now I know that, Point72 is starting as well, and Jane Street and a bunch of others are starting DeFi funds as well. Yeah,
and the beautiful part is it's not just long short only. I think the traditional approach to the crypto world is that you have to trade a native asset or a native token. I think DeFi is going to show that you don't have to do that. You don't have to take on that exposure. You can sleep comfortably knowing your asset isn't going to move. It's an 85 vol asset versus the maybe 15 vol stock that you see day to day. So
yeah, this would be 100% arbitrage income component given the interest rates and the arbitrage opportunities that currently exist.
Yeah, I saw someone mention Mirror. Mirror was, it's a great way for, I think, someone to just initially step their foot into what is DeFi, participating in the ecosystem. Essentially, it's a synthetic asset, decentralized exchange. So the governance team, which is anyone who owns Mirror tokens, can participate on listing more equities or more ETFs or more other products that they'd like to trade, and it can get approved. So now anyone providing liquidity can receive pretty impressive yields for just being there to be the market maker and continuously provide a bid offer essentially.
Can these assets be hedged in the real world?
They can, yeah, and that's the part that's a new frontier. It's no one has really taken a big institutional approach to doing something like this, which I think there's a lot of arbitrages in themselves there because, for example, you own a synthetic version of an equity on exchange that has, you kind of know its payoff curve, although it doesn't have different maturities. You can build an option to probably hedge away your deltas on a lot of these trades. So very exciting stuff.
Can you short VIX mirror futures and then buy VIX futures in the real world and arb the difference?
You could, yeah, you could. You'd be taking on a couple of unique risks to the DeFi world by minting VIXy futures or the front month for the VIX, but could be very exciting. A lot of cool opportunities out here.
I'm just wondering how much you'd have to put up to do that, and if that would diminish your overall returns.
Yeah, it can range. Generally for minting assets on Mirror, it can be like 200%. So you're definitely over collateralized because they want to be there to liquidate you if you fall below that threshold. So
right, it's a forced margin process. I mean, the moment it hits, you either have to put more in, or you've got, how much time do you have before you have forced liquidation?
Yeah, it depends on the exchange. There's some exchanges that they'll tell you every hour, here's how much you need by the end of the hour. And there's some exchanges that will tell you like instantly, this is what you need to deposit, and they'll go ahead and pull the money if you've given them approval and you have another account that you've linked to. So, but yeah, that's about it that I have. I mean, all of this is around building an institutional yield generating strategy that is robust and not just long short. So happy to talk more about that if people are interested. Looks like there's a ton of good questions coming around.
Yeah, I think for anybody that has a question, this is your time. Like, please ask away.
I posted a question because you've covered a lot of information. So, I'm a programmer, been a trader for decades, and I understand blockchain, but I'm not into the minutia of all this. Where would be like a DeFi for Dummies book, or what would you suggest as a starting point, both for somebody who wants to invest and somebody that would want to like maybe program this kind of stuff?
Yeah, there's a fantastic intro to DeFi tutorial series on YouTube that was made by the folks at Zapperfi. It starts from the basics. I can actually throw a link in here, and happy to pass that around later too. It's like a 30 video series from the basics of DeFi to how to trade. So,
and we can include that too in the email that we send tomorrow out, because we're going to send a recording of everything, and we'll include a link to this DeFi series so you can just all go really deep into it.
Awesome, just do it in there. Oh, there's so many questions in this chat. I wish I could answer a lot of them. There's some on energy usage. Happy to kind of share the differences in proof of work and proof of stake, and then delegated proof of stake and different consensus mechanisms and how that can have different energy usages. So a lot of people refer to a couple of events that happened in 2017 and 2020, which showed that a lot of the mining load for BTC was coming from Xinjiang, which was running on coal. So there's been a proposition to say, can we actually figure out what type of energy most of the miners are running on? There's a lot of debated numbers, whether it's between 25 and 40% of BTC mining energy expend was coming from a renewable source, but these are things that are still to be determined. And that's why I think proof of stake also has a pretty exciting solution to this that is not energy intensive, just relies on validation from nodes participating purely digitally on the consensus mechanism that we can jump into, and I can share some cool links about that. Really good question. Wouldn't an easy way to invest in this just be to buy Ethereum? Well, since the DeFi ecosystem right now is largely Ethereum driven, I think we have seen a very fair price response in the adoption of it. I think Ethereum now trades larger on a market cap basis than almost all the banks in the US. I think people have quickly come to realize the usability of it and the entrance that it can provide onto participating in these decentralized apps. So
But that is still taking delta risk, where there are a lot of opportunities to make fairly high yields without the delta risk of having the price. But also, right now most of it is happening on ETH. But what about if things move away to Solana or something else that's competitive?
Yeah, and ETH has been a 1-year story. It's like 12x or something in the last year. And that's just as people are seeing very exciting dApps being built on Ethereum, right? In a couple of years, like you said, there might be 4 or 5 other blockchains that are very competitive, but don't like to not bet against growth. So
is it possible for the government to step in and need to put in KYC and like all those type of things into the crypto space?
it's a great question, and I wish I had like Brian Brooks or someone really smart legal guy out here to help me out with this question, because I think it's tough to predict where regs go in terms of KYC, particularly because of the pertinent issue that eventually you may be passing on from a block something that was owned by a sanctioned entity or an unapproved entity. So there's a lot of work that I think the IRS, as well as there's a couple of like FinReg groups in the US that are also working on defining what this looks like for the next couple of years. Tough to say. I don't have a good call on that myself. I think we'll see as it comes, and industry will respond as it comes.
Great question too. I see that 2 days ago, their yields were 16, 20%. Now they're 46. So this is a classic example of that short-term debt cycle that we talked about before. Most demand for borrow rates in crypto space literally comes from speculation. This is a classic proof of it. When the price goes up, people borrow to buy more, and that drives it. Last few days, we've seen a pretty big drawdown in crypto. And as a result, less people want to borrow the crypto. So the yields you're getting in the DeFi space are fairly correlated with the price of crypto. But just like a bondholder, when you're lending, you're not getting you don't get the price fluctuation. The only loss you're seeing is you're just getting less yield.
So if I'm understanding this, a lot of this that you're referring to is people borrowing money that's collateralized at 100% to bet more on Bitcoin or whatever.
That's exactly right. Like think about it, that's a brokerage firm. Like they don't have access to traditional brokerages. You are essentially providing a margin loan at a high rate.
And then who breaks ankles and kneecaps?
The smart contract.
Yeah.
Smart contract.
Cool.
There's another question here about, let's say everything works exactly as it's supposed to. Best case scenario, I can talk at a high level. I think it's mostly going to be adoption from traditional finance institutions who are now moving a lot of their lending infrastructure on chain and finding exciting ways for them to rethink the whole, like, let's optimize your FICO score as much as we can and figure out what bucket you fall into, and then accordingly give you a smart loan based on that value, just to outright looking at what assets you have in your account and then how quickly are they transferable. I think in the last couple of months, as Itai mentioned, there's been a massive amount of institutions coming in to participate in this yield farming space and look at it. A lot of them are actually coming from the long short side, like 0.72. Their bread and butter has been that for a while. So it'll be exciting to see how they find their way to survive and go through these short and long-term bull bear cycles in DeFi lending.
Cool. Well, I think what we'll do is we're about at 1:15. So I know, Udav, you did an amazing job putting this all together. So what we'll do is, for everybody else who wants to go, this could be a time to go. I'm sure some people are going to sit around and want to ask you a whole bunch more questions. So for everybody else who came, thank you so much. We appreciate it. If you're interested in seeing what we're up to, just visit equi.com, equi.com. We're about to actually go live within the next month, and we're actually accepting our first batch of applicants. So meet us there if you want to learn more. And for anybody else who wants to stay around, we're going to pause the recording and we're just going to answer questions. Okay.